Welcome to the Essential Tax Podcast with your host, Mishkin Santa. In each episode, we'll take the complex world of tax, all the jargon, acronyms, and stuff that make your eyes glaze over, and explain it in an impactful way to understand the complex and unknown areas. You can find this show on all the major platforms, including YouTube, LinkedIn, Apple Podcasts, Spotify, and on our website, thewolfgroup.com. Now, here's the host of Essential Tax Podcast, Mishkin Santa.
Hello, everybody. Welcome to the podcast, where this podcast should be coming out on quote unquote International Podcast Day. So I think that that's pretty cool, getting this podcast out there for everybody. And in honor of International Podcast Day, this is going to be a brief podcast, but we're going to talk about some cool topics. We're going to go into social media influencer guidance for tax practitioners. So I'm looking right at myself. Things to think about when you're doing those social media posts or podcasts or blog posts and whatnot. We're going to talk about charitable contributions and things to think about for potential tax planning for both itemizers and non-itemizers. We're going to go into a brand new schedule that the IRS just released, Schedule 1A. Talk a little bit about that. And then we're going to wrap up the discussion with talking about a pretty big change that's happening at the IRS at the end of the month of September related to refunds and paper checks. So that's kind of the agenda or itinerary, if you will. But without further ado, let's get into the first topic, which is the social media influencer guidance. And for those that are just listening on audio, I am kind of showing some slides here on this. So the first thing to understand when it comes to being a tax practitioner is that there's not a whole lot of regulation on tax practitioners. I went to a recent IRS conference, and it had a lot of quote unquote tax practitioners there that were either, unlicensed or enrolled agents, and you kind of got to see, all the different people that could represent someone doing a tax return or tax controversy practice. And it's kind of all over, there's a lot of different variations that are going on there, but the standards or regulations that kind of are applied to tax practitioners generally come from a circular that the IRS has released, or the Treasury Department has released, I should say, called Circular 230. And those regulations govern the practice before the Internal Revenue Service. And if you violate those regulations, then you can be censured, you can have your license taken away, you can lose your ability to practice before the IRS. In fact, the IRS publishes, I think it's on monthly or maybe a quarterly basis, the list of tax practitioners that have violated Circular 230 and then had an issue there. So there is some guidance there. There is some accountability there with the Office of Professional Responsibility. Those are the ones that enforce Circular 230, but it hasn't been updated to deal with social media influencer podcast issues, for laying tax advice through those things. There's been a lot of, if you scroll through Instagram or TikTok, you've probably seen something where someone has been promoting some kind of, hey, do this, pay less tax. Hey, just so you know, this is available to you out there. You should do it. Here's why. A lot of that content, if it's not from, a very reputable source, has proven to be very problematic. People have relied upon those postings through TikTok or Instagram or Facebook to their detriment. And we'll talk about that here in a little bit. Because the IRS will catch you. If you do something wrong on the return to that level, it will be abundantly clear, and there will be ramifications for that. And again, we'll come back and chat about that here in a second. But the big thing to understand is when is a tax practitioner on the hook for advice given through the medium of social media or some kind of social media content like a podcast. And the most recent case we have on that, it's a very old case, comes from 2002. It's the Neontology Associates case. And basically, there's a 3-part test that has to be satisfied before you can, quote unquote, have reliance on a tax advisor. So first off, the tax advisor has to be a competent professional in the area that they're talking about. So for example, if you have a tax advisor that knows nothing about international tax and they're providing guidance on foreign trust reporting on forms 3520 and 3520A, and they haven't really, taken any classes or done any of those filings, then they generally are not a competent professional in that area, and that they would not qualify there. So there has to be a level of competency for that advisor. Okay. Secondarily, the actual person that took the advice, quote unquote, the taxpayer, has to provide the tax advisor. So there has to be kind of a two-way street here. Their facts and circumstances, documentation to review, all that stuff. And then, the tax practitioner has to analyze that and come back with their thoughts on, the specific facts and circumstances. And that's why we always say when we talk to clients, facts and circumstances are terribly relevant. They change the analysis, they change the outcome. There is no one size fits all. Be very careful about reading something online and saying, "Oh, that's my situation. I'm going to apply what's said in that article, or that blog post, or that Instagram video to my situation and run with it." That certainly will not work if it's wrong. And then obviously the taxpayer has to rely on good judgment, the good faith and judgment of the tax practitioner to their detriment. Okay, so that's the three-pronged test that everyone needs to be aware of. To my fellow tax practitioners out there that are doing content like myself, here's and I kind of gleaned this from several different articles I've read, but here's my kind of general take on it. So first off, always use a disclaimer. So in the podcast, we have a disclaimer that we use. We put that disclaimer, pretty much everywhere. Put it in your memos. Put it in if you're giving tax advice in an email, put it in the email. But have your disclaimers in there. Your Circular 230 disclaimers. Have a firm policy. Like, what's your firm policy for content? If you're going to do content, what is that firm policy? And then stick to that policy. As the TLC song says, don't meander from the rivers and the lakes that you're used to. So get that firm policy in place and then stick to it. If you're going to give content, if you're going to produce content, if you're going to tell people about things, talk about big picture, very general topics. Don't try to go to very individualized recommendations. So, the other day I saw someone that was very, trying to specifically say, oh, well, Taylor Swift and Travis Kelce are now engaged. And so Taylor Swift should consider for her specific situation these types of trusts for planning and estate planning and so. And it's just like, that's a very specific, you're getting kind of in the weeds there a little bit. It may be fun to use them as an example for big picture discussions. I certainly did that when Meghan Markle was married in the royal family. I kind of talked about, okay, well, let's talk about a situation where maybe you have a U.S. person that, joins up with a foreign family, a non-U.S. family that has foreign financial assets. And then what would that look like for U.S. reporting? But you got to be real careful about being super, super, super specific. The post should be educational in nature, just to draw big picture things that people should be aware of and that they should investigate further with actual tax professionals. When someone makes a comment on your post, if you're going to comment back, be very, very, very careful. In fact, I would tell you just to not respond to comments. Probably don't even look at comments because you may not like what people are saying about you. But if, for example, if a client were to make a comment about something that I put out, and then I go back and respond to that client about their specific facts and circumstances, I may have violated Internal Revenue Code 7216 because I've now shared something about that client with everybody that's on that thread and anyone new that comes in and reads that thread. And that would be my last point here, is that there is Internal Revenue Code 7216, meaning that you can't talk about your client's information. So if someone's a client of mine, and someone asked me, is so-and-so a client of yours? I would not even be allowed to respond to that because of Internal Revenue Code 7216. I can't share client data. Okay, so keep that in mind for all of you that are doing those type of activities through social media. Okay, next up, I want to talk about OB3 and charitable contributions, because we're in fourth quarter 2025. We have this new tax law. We got OB3. There's changes to both itemizers and non-itemizers. Mish, what's a non-itemizer? That's someone that takes the standard deduction. What's an itemizer? Someone that itemizes their deductions on Schedule A. So first thing I want to highlight are the itemizers. So the folks on Schedule A. So starting next year, not this year, there are a couple things that you got to be aware of. First off, there's a floor that is now added in to charitable contributions for itemized deductions, meaning that your charitable contribution has to exceed that floor amount before it will count. So an example is, I'm a taxpayer, I'm filing single, I've got an adjusted gross income of $1 million, and I decide I want to give $100,000 to a qualified charity. Well, under this new 0.5% floor, the first $5,000 of the $100,000 that I gave is not going to be deductible. It's not going to be recognized. So on my Schedule A, only $95,000 is going to be put through as a charitable contribution. Again, that's not for 2025. That starts on Jan 1, 2026. Number two, and tax practitioners always talk this way, and they'll say, well, look, for every dollar you give, you're in the 22% tax bracket, so you only get 22 cents on the dollar for a deduction. Now, and which is true, because you have to look at your tax rate, and that kind of tells you for every dollar you contribute for charity what you're actually getting as a deduction. But that would go all the way up to 37%, which is the highest bracket. Under the new tax law, it's actually now capped at 35%. So for every dollar you give, if you're in the top tax bracket of 37%, you're not getting a 37 cent deduction. You're only getting a 35-cent deduction. Okay, so there's a cap there. There's a permanent cash contribution to charities at 60%. That's the way it's kind of been for the last couple of years, but that was set to sunset at the end of 2025. That's now permanent, so that's still in place. And you can carry over. So if your cash contributions are limited due to the 60%, any amount that's limited can carry over into future years. Why am I saying all this? Well, if you don't want to deal with some of these things that are limiting your charitable contributions for 2026, you may want to make some large charitable contributions here in 2025, maybe through a donor advised fund. That's a great way to lump up charitable contributions. And then anything that is limited under the 60% cap then would carry forward into 2026, 2027, and so forth. So I guess the big takeaway here is that if you're an itemized filer, 2025 is the year that you want to target to try to maximize a lot of charitable contributions, and you may want to do one big lump charitable contribution in 2025. Okay, let's move on to non-itemizers, okay? So if you took the standard deduction and you made charitable contributions, you didn't get any, that didn't help you out at all. No, it didn't come through, except randomly during the COVID years. I think they let a couple $100 come through. Well, starting in 2026, again, not 2025, if you're an individual and you make $1,000 of charitable contributions to a qualified charity, you can take that as a deduction. That's the maximum amount. And $2,000 for married filing joint. However, there is no carry forwards. So for example, if I'm married and in 2026, I make $3,000 of charitable contributions, my limit will be $2,000, and the other $1,000 just dies with the tax year, doesn't go anywhere. So you got to watch how much you're contributing if you're doing it just for tax purposes. Hopefully you're doing it for more than tax purposes. Hopefully you're doing it to be charitable. But the big takeaway here is that if you're taking the standard deduction, maybe you wait to make charitable contributions in 2026. You would do it on Jan 1, 2026, and do it, if you're just doing it for tax purposes, do it for the levels indicated, 1,000 or 2,000. Otherwise, they may not carry over. Okay, the IRS has published. They're already on it. They're on OB3. They're putting out new forms and schedules. The 2025 tax return will look different. It will look and feel different than the 2024 tax return. And for those that are familiar, if you look at a very basic 1040 tax return, it's 1040 pages 1 and 2, schedules 1, 2, and 3. Now, in addition to schedules 1, 2, and 3, there's schedules 1A, which now has pages 1 and 2. We have a blog post coming out kind of explaining each of the parts and sections here, but this is basically the calculation of the no tax on tips, the no tax on overtime, the no tax on car loan interest, and the enhanced deductions for seniors. So there's going to be a lot of scrutiny, I think, on this form because, as I say in the blog post, a lot of this is driven by the taxpayer or taxpayer's modified adjusted gross income. And if the modified adjusted gross income, otherwise known as MAGI, is a little too high, it could knock you out of some of these deductions. So really, there's a lot of thought that has to go into these new deductions and planning that you didn't really have to do before. I told a client this the other day. I said, since the Tax Cuts and Jobs Act of 2017, people have probably been just asleep at the wheel on itemized deductions because that bill took a lot of that stuff away. The Easter egg hunt was over. In fact, I think recent statistics show that only 8% of people are itemized filers. Well, now, because you have all this kind of new stuff floating in there, whether you're an itemized filer or non-itemized filer, you really got to pay more attention to it and put a lot more thought into it. So your Schedule 1A, which is for standard deduction only, this has nothing to do with itemized deductions. These are the deductions that only go for people taking the standard deduction apply on Schedule 1A. So that's where that's going to come from. Pay attention to that, and then pay close attention if you are an itemized filer on Schedule A, which will also change and probably accommodate a lot of the things you're seeing on the 1A. I have linked this to the show notes, so you can find it there if you need it. And then the last topic for today, we have a blog post on this already out. It's on the website. I'll link to it in the show notes. But there was an executive order from the president back in March of 2025. And basically, it's an order to tell the Treasury Department that paper checks are no longer a thing, which I think is a good thing, right? You're killing trees, so we're not going to kill trees anymore for paper checks. Paper checks are also tend to get lost, and then you got to do refund traces. And if you're a U.S. person living in a foreign country and you get a paper check, good luck cashing that with a foreign bank. They're not going to do it. You probably got to fly back to the U.S. I think it's within 1 year receiving it to cash it. So this is one that I'm actually a proponent of when it comes to executive orders. But here's the rub here. The no more paper checks starts on September 30th. So if you filed a tax return requesting a refund and haven't provided a bank account, and the return is processed after September 30th, there could be some issues there that you may have to resolve with the IRS. You could get IRS correspondence on this. And the blog post that we wrote kind of goes through all the nuts and bolts on it to consider, and iterations to think about, especially for people that are filing tax returns now in the extension busy season. The last thing that I'll leave you with, which is something that I'm hoping for, strangely enough, if you're getting Social Security, the Treasury Department will deposit your Social Security checks in a foreign bank account. But if you're getting an IRS refund, they won't. And what I'm hopeful for is that alignment happens where the IRS systems kind of get on the same system as Social Security. And so for individuals living outside the United States that are due a refund, they can then get that refund into their foreign bank account, just like Social Security payment. Now, there's limitations to that for Social Security. It doesn't occur for every single country. They have it divided out between certain zones. But any step forward on that would be, I think, welcome by expats living outside the United States. And that, boys and girls, is my rundown for today's podcast, International Podcast Day. Thank you for being with me here today on that day and celebrating that. And we hope to see you next time. Thank you.
You've been tuning in to the Essential Tax Podcast with your host, Mishkin Santa. You can find this show on all the major platforms, including YouTube, LinkedIn, Apple Podcast, Spotify, and on our website, thewolfgroup.com. Thank you for your positive reviews, comments, questions, and for sharing this show with others.